Hello learners, welcome again to Manifested e-learning platform, and I would like us to continue with our revision. Today still we are going to look at May 2018 question number 3. May 2018 question number 3. The question reads like this. Jua and Kali have been trading as partners under the trade name Jua Kali Enterprises since 1st January 2016. They have not filed individual income tax returns for the year ended that was December 2017. The Commissioner of Domestic Taxes has issued an estimated assessment of $784,000 to each of the partners for the year ended that was December 2017. They share profit and losses in the ratio of 2:3 to Jua and Kali respectively. They are preparing to appeal against the assessment and have approached you for a tax advice with the following details. So we are given the cash book summary. On the debit side, we have the opening balance, capital, Jua and Kali, correction from the debtors, cash sales, rental income, and sales of furniture. Under the payments, we have payment to creditors, purchase of furniture, motor vehicle expenses, electricity expenses, rent expenses, purchase of motor vehicle, salaries and wages, office partitions, general expenses at balance carried down of 2,318,000. Additional information. The cost of furniture sold was 160,000. It had accumulated depreciation of 14,000 as at 1st January 2017. Profit on disposal was credited to the income statement for the year ended that was December 2017. All the cash sales were paid into the bank with exception of 440,000, which was debited in the income statement as general costs, but related to the following items: partners' children's school fees, 80,000, purchase of goods, 200,000, tax appeals, 40,000, insurance policy for the partners, 70,000, and computer softwares, 50,000. Other information was provided as follows. And we have the opening and closing balances for inventories, creditors for the goods, debtors for the goods, electricity expenses prepaid, rent owing, salaries and wages owing, and then we have furnitures. The business reported a net loss of 424,500 for the year after deducting the following expenses: salaries and wages for the partners, Jua and Kali, 100,000 and 80,000 respectively. Rent expense for the year included 20% for private residents for Jua, or electricity included 30%, electricity bill paid on behalf of Kali private house. Capital allowances in respect of the business had not been considered. However, depreciation had been debited in the income statement and it was charged at a rate of 20%. Sales and purchases for the year were understated and overstated respectively by 20%. The partners are entitled to interest on capital at a rate of 10% per annum on their capital contribution. The interest on capital was included in the figure for the purchases for the year. Required. With supporting computations, advise the partners on the accuracy of the estimated assessment issued for the year of income 2017. Prepare a schedule of total taxable income for each of the partners for the year 2017. Hint, start with the adjusted net loss. Part B, transfer pricing remains a major threat in bridging the tax revenue gap in your country. In light of the above statement, Evaluate 3 factors to be considered in the selection of an appropriate transfer pricing method. So, I would like us to start with part A. That is part A. Part A, we want the estimated. You advise with supporting computations, advise the partners on the accuracy of the estimated assessment. So if we have to advise these partners, it means we need to calculate the partnership adjusted profit and we share that to the partners so that we can get the total taxable income for each partner. Then we advise whether those estimated assessments, whether they are overstated or they are understated. If they will not agree with the figures that we are going to get, then you tell the partners to object. But if they agree, then you tell the partners to accept. So we are going to start with the computation of the partnership adjusted profit. So we have Juakari Enterprises, Juakari Enterprises, computation of partnership adjusted profit for the year ended that 1st December 2017. So we have particulars and we have shillings here. In this question, we are supposed to use indirect method. That's why we are given a hint to start with the adjusted net loss. So we are going to use the indirect method. So reported net loss. And the reported net loss for our question is 424 500. So under indirect method, we are supposed to add back disallowable expenses. So what we mean is those expenses that were subtracted when calculating this particular loss and they are not allowable, we add them back. That is what we mean by the disallowable costs. And I'm going to start with note number 1. At the note number 1, they are saying the cost of furniture sold was 160 and had accumulated depreciation of 14,000 as at 1st January 2017. Profit on disposal was credited to the income statement. So for this one, unless we calculate now the depreciation, because if I consider again note number 4, the last bullet, depreciation had been debited to the income statement. So here, unless we add back now the depreciation, so we can have depreciation. Depreciation is not allowable. Depreciation of furniture. But for this one now we have to calculate. We can have workings. So I start with the depreciation of furniture. So in order for me to calculate the depreciation of furniture, I need to prepare the depreciation account. The depreciation account. And in this case, we are told at the note number 1 that as at start, the cost of furniture sold is 160 and had accumulated depreciation of 14,000 as at 1st January 2017. The profit on disposal was credited to the income statement. So we can have that depreciation account Then we can have a disposal account. Then we can also have the other account, that is furniture account, so that we can get now everything at a go. Debit. If I look at note number 3, I have the opening balances for furniture. So I have balance brought forward. For the furniture is 160. Balance carried down for the furniture, it is 200,000. 200,000. Then there is this furniture that was disposed. If we buy more furniture, you add. If you sell, you subtract. So we have addition because under the cash book summary we bought furnitures worth 200,000. So here we have additions. Furnitures 200,000. Furnitures worth 200,000. Then again I can see this furniture, we also disposed furniture. Under note number 1, the cost of the furniture sold is 160. So we have disposal 160. So now if you look at this particular account, what we had as at start, then we disposed that, then we added this, so you'll find that it is automatically agreed, that is 360,000. Because if you you start with opening balance, it has to agree with this particular balance carried down. We can go to the disposal account. For the disposal account, you capture the cost of that particular asset here, and the cost of the asset that is disposed is this one, which is 160,000. Then you capture the sales proceeds. The sales proceeds, this asset was sold for 170,000. It was sold for 170,000. That is the sale of furniture. Then and the cost was 170. We need now to get profit or loss on disposal. So this asset, the sales proceeds is 170. This is cost. So you also capture its accumulated depreciation. So that now you can get profit or loss on disposal. So we go back to this account so that we can get now the depreciation. So if you look at note number 1, the opening balance for the depreciation is 14. So balance, this is provision for depreciation. So balance brought forward, it is adding up to 14,000. Then you add depreciation for the year. And the depreciation for the year, we are calculating depreciation as 20%. So 20% you multiply by the value of the furniture as at the end, which is 200. So this is 40. That is 40. So it means that balance carried down, we calculate it there. Then we have an asset, this asset that was disposed. So its accumulated depreciation is supposed to be debited. So you come here, you put under disposal account. So the depreciation that is the asset that is disposed, its accumulated depreciation is 14,000. So balance carried down for the depreciation is 40, and again therefore accumulated depreciation for this asset disposed is 14. So we get the total. So 40,000. Then this income, profit on disposal, we are told that it is included in this particular loss. So we are going to subtract it later. So the depreciation for the furniture is 40,000. So you add it back. Then we can also finalize with the other depreciations. The other asset that is depreciating is motor vehicle. Motor vehicle, this one does not have we have only one transaction. So depreciation is calculated at 20%. So 0.2 you jua kari, and their salary is 180. The other one, rent expense for the year included 20% for private resident for jua. For electricity included 30% paid on behalf of kari. So in that case, therefore, we have private rent that is not allowable. At this private rent, we are told it is 20% of what? Of the total rent. So first of all, we get the total rent. The rent that we paid in the question is 394. That is the rent paid. Then when you look at note number 3, there is rent owing of as at the end, so plus 44. Owing as at the end we earned minus 78. So that one should give us private rent, and that one is not allowable. You add it back. Again, we have private electricity, which is 30% times into bracket. The electricity that we have paid is 78 in the question, but in the question we have prepaid expense electricity. Prepaid we add as at start, which is 472, minus prepayment as at the end, which is 30. So you get now the amount. So we have the first one, 394 plus 44 minus 78. You get 360 times 0.2. You get 72. The other one is 78 plus 472 minus 30 times 0.3, 156. That again is not allowable. Good. The other one, we go to note number 4. Number 4, the last bullet is about capital allowances, and we have addressed that. But number 5, sales and purchases for the year were understated and overstated respectively by 20%. So if the sales are overstated or understated, then you need to look at their effect on this particular profit or loss. So it means we need to get our sales, we get that overstatement, we get our purchases, we get that overstatement, then we adjust here.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.